Good Wednesday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market short. Before we get started, please take a look at the shared screen and the disclaimer and realize that Market Chameleon, myself, and Dimitri are not registered investment advisors or broker-dealer. If you're searching out investment advice, please reach out to a licensed professional. This show is for informational purposes only concerning Market Chameleon tools and products. And with that, D, you want to get going?
Yep. Good morning, everyone. And let me share my screen here. Also, before we get started, if you're new to our show, Will and we do these shows in the morning to try to help answer questions you may have about the Market Chameleon tools, the data, or the analytics. And if you have a question, type it into the live chat on YouTube. We'll keeping an eye on it. He'll let me know and read it back to me. And to give you a couple minutes to put those questions in, we're going to take a look at our pre-market report and see if we could get insights, what's going on in pre-market hours, and then we'll move on to our questions. So let's get started here. In this pre-market report, what you will see is this calendar view up top. And this gives you summary statistics, what happened in the pre-market hours on these particular historical dates. The idea there is you could compare what happened in the most recent history with what's going on today, which is over here, May 15th. And so let's start out with today's summary stats. And here we could see that in a pre-market so far, we have 706 stocks trading higher, 255 stocks trading lower. In pre-market, we have 758 million shares trading on up volume, 109 million on down volume. And if we convert that volume to dollar value, we have $4.9 billion worth of stock trading higher, $1.6 billion worth of stock trading lower. From that perspective, looks like so far trading in pre-market hours has a bullish bias or bullish lean. Let's look at it from a couple more perspectives before we go on to our questions. And let's slide down here a little bit. And now we get this granular view of the pre-market trading. Today's pre-market trading, we see stock symbols with price changes, and volume. In pre-market, we have our most active list over here, our biggest percentage gainers, biggest percentage decliners. When I scroll down here, I see 203 stocks made it onto our biggest percentage gainers list, 49 on our biggest decliners. So from that perspective, it also indicates a bullish lean in pre-market trading. Now, to make it onto this list, we set certain thresholds because stocks in pre-market can trade with low volume, low liquidity. And if it meets our thresholds, it can make it onto this list, which will include small cap stocks, it will include ETFs, leverage products, inverse products. So to narrow down to a smaller group of stocks, we could use our filters above. If you have a watch list and you saved a watch list of particular group of stocks that you track and follow, you could filter out this report by your watch list. We're going to use this in ETF filter in our example. I'm going to click on it and you get this drop down menu to select from. These are different ETFs. We're going to click on this first ETF, SPY. And when we did that, the report below got filtered by stocks that are holdings in SPY ETF. And this narrowed down our list to S&P 500 stocks. Okay, so now we're just looking at the S&P 500 stocks to analyze. And here we have 20 stocks that made it onto our biggest percentage gainers list, one on our decliners. This also indicates that there is a bullish lean in the pre-market trading activity. We looked at it from three different perspectives, and they all kind of indicate the same bullish sentiment. And we gave it a couple minutes. Well, if you have a question, I will take it now.
No questions have popped up. We did have Fred, a new individual, come on. He said the single leg tool should be very interesting. Fred, I don't know if you're coming over from IBKR, but welcome.
Yep. All right. Thank you. So why don't we do that? Let's look at the single leg tool that we analysis tool that we were talking about yesterday. It's a new tool. So maybe, we'll take a couple days and go over it. And to pick out a stock, let's go to under the options, we can look at the options volume report. All right. So I'm going over here and I'm bringing up the options volume report. And now we have the different stock symbols, and they're sorted by this column here, which is the dollar value of all the options traded. So this is going from highest to lowest. Okay, so the NVIDIA yesterday traded almost $2 billion worth of options. That was on the top of our list based on that metric. And you could see here Microsoft 1.3 billion, 900 million in SPY and so forth. If you wanted to switch just by contract value, you could use this switch here. And if I do that, now we'll show you the volume of contracts. And just a quick note, since we're looking at it, you could see that SPY traded way more contracts, 6 million. So we could resort it by that. The reason NVIDIA was on the top of the list, even though it traded 809,000 contracts, which is obviously less than 6 million, is that the dollar value of those contracts were higher, right? So you could trade contracts that are penny, 5 cents, or $40, and that will make a difference. So that's the difference between the notional value. Let's just click back here. So what we also see here in this report, before we pick out a particular stock to look at, is this is yesterday's dollar value. This is the average daily using the last 90 days. And this gives us the ratio. And this relative value just lets us know is the volume that's traded on the day. So we're closed. This is using yesterday's data. The volume traded on the day relative to what it typically trades, is it high or low, and by how much, right? That's the ratio. Yesterday's value versus average daily value. So here at Microsoft, yesterday, the volume was 5 times greater in dollar value than you typically see. Okay. SPY is lower. Here's GME. GME was 78 times greater. So maybe we'll take a look at GME since it's such a high number. Yesterday, $815 million worth of options traded.
Is that GameStop?
That's GameStop. Yep, right here. And typically trades about $10 million worth. So you could see that's, almost 80 times, right? And here we could see 78% of that volume, 78% were in single leg trades, 21% were multi-leg trades, 1% contingent. So we could look at these separately. What we do is bucket off the single leg trades, multi-leg trades. So we could just look at them and analyze them apart from each other to get a clearer picture. So let's do that. We'll go to GME. Okay. So I'm going to click on that. And opening the page over here. Oops. So this is GME over here. And I'm going to go under options. And under options, we're going to bring up the single leg dashboard. This is analyzing just the single leg option trades, calls and puts that were not marked as multi-leg or contingent on the trade tape. And the idea here is our first question. You typically will have three questions that you want to answer. One is, well, what's going on in the trading and why? And why are people doing? What are people doing? And why are they doing it? Then how's that impacting the markets? Whatever they're doing, how's that impacting the markets? And then is there an opportunity there that I could find a trading opportunity? So when we talk about the first part of it, what are people doing and why? The why part, you're not going to necessarily get it from the data because you will have to link it to news. Is there news? Is there something going on where it's being recommended? Is it on the TV? Is there an upcoming event? Right? Was there an earnings there? So the why part will take, extra research that you should go and figure out. Like, what is the news here? Is there an upcoming event? Is there something going on? Is there a lawsuit? Because if there's massive trading activity, you'll need to do that part, of it. And, you could go here, look at the news, whatever else we could look at upcoming events. Is there earnings? We could look up, whatever sources that you tap into that's trusted, your Twitter feed or whatever. Okay. So that's an important piece that as a trader, as an analyst, as a research risk manager, you will need to do. So then what's going on? What are people doing here, in GME? So let's just take a look at the breakdown in aggregate, how they're using the call and put options, single leg first. Okay. And here we see that a total of 628,704 contracts traded that were single leg. Okay. The breakdown of it is 47% calls, 53% puts. That's the volume breakdown. If we interpret what was the incoming order looking like from the end user, we talked about this. This is based on interpretations using the surrounding data. We tagged it as 77% of the volume. The order flow looked like it was coming in from the buy side, 16% from the sell side. Okay. Which also kind of makes sense because we see the implied vols were up a lot as well. Now, how about the quality of these executions? How are people getting executed on their trades, single leg trades? So then we could come over here and we see that 74% of those trades were executed with an auto execution, which means it was electronically matched in the trading engine when it came into the market. 18% of those trades, 18%, were stopped and received a price improvement. So the price improvement auction, special feature on the exchange where you enter in an order and there is a second where it flashes to your order to market maker or specialist, asking if they're willing to improve on the bid or offer that you submitted. And if they're willing to improve and say, well, I'll do even better, that's 18%. What's better? Well, let's say you entered in an order for, you saw a bid and offer and you said it was $1 to $1.10. You're like, I'll buy $1.10. but you got a $1.08 execution, right? Well, that's you got a price improvement. You actually received a better price than you were willing to pay up to your high end. So then, that gives us an idea how things are getting executed, that, well, there are, hidden liquidity that are willing to even transact at better prices than the displayed prices. Okay, so all this, as we're going through, we're building the picture of how things are trading. Before even entering executions, how are things trading here? And that's what we're starting to build the picture. Next, 7% of the trades were intermarket sweeps. Well, intermarket sweeps those are the aggressive orders that if you want to get filled at a certain price, and you see that there are prices on different exchanges, even though they might be, some exchanges have, prices that are inferior to other exchanges, but you don't want to miss out on that liquidity. An intermarket sweep will grab the top of book on those on multiple exchanges simultaneously. Okay. The reason for that is that if you send it, even though, like, say, one exchange is displaying a better offer, if you go there first, take their offer, and then it takes time to go to the next one, and then the next one, the stock could move, and then you could get an inferior. So if you want an immediate execution, said, I don't care, I want to go all the exchanges simultaneously, I don't want to go one at a time. That's an intermarket sweep order. It's aggressive, right? Because you might get an inferior execution by doing that. But what you're doing is trading off potentially inferior price for immediate access to liquidity, because you think if the stock moves, then I'm definitely, chasing it and getting a worse price anyway. So that's an intermarket sweep. 7% of those were intermarket sweep orders. Then 1% of the single leg trades were floor trades. So not a big amount, 1%, but what a floor trade is a human touch trade. Okay. Human touch means that you're using a broker to try to negotiate verbally with other players, right? Other market makers, liquidity providers, to try to execute a trade at a better price. It could be, and sometimes it's, a bigger amount or a better price, or maybe sometimes the people cross, those, like, people, you have two people willing to trade versus each other at a certain price. They could do it as a floor trade. So it's not a big volume. That's what's telling us. Most of them are getting hit electronically. But if it was a big volume, let's say it was 90%, well, we're like, well, hold on a second. That's a little bit different than lots of trades coming in electronically, right? That's what it's telling us, that it could have been just, a person that needed something in specific, and they weren't looking for anything that essentially immediate. They were more concerned about getting that specific trade at a certain price that they were trying to negotiate, maybe an implied volatility that they were targeting on a specific option. Okay. So now we're seeing how now we're building pictures of, okay, the calls and puts are almost evenly split. The buy order flow looks like it was exceeding the sell order flow and balance on volume. Most trading is going on electronically. There's some price improvements there. So far it seems like lots of, just, it could be lots of different trades coming in. Okay, most of them are just electronic. happen on getting matched up electronically. The trade versus market kind of says, okay, if we use the state of the market at the time of the trade, the bid and the ask, and just use that to see where the trades tend to get executed, how's that distribution look like? Okay. So this is the quality is do they always have to trade on exactly the bid or ask? Are they trading in between? Are they trading exactly midpoint? How does those look? So exactly midpoint, that's 5%. So it's not a great deal, if you're used to looking at it, you'll find a lot of times even in the teens or high teens. So it 5% probability like that you could get hit in the midpoint if we took everything across the board. So what about relative to the bid and offer? So you could see slightly more are getting hitting the bid than taking out the offer. 28% on the hitting the bid, 26% on the offer. What about maybe not on the bid, but closer to the bid, right? Below the midpoint, but closer to the bid. That's 21%. Above, 18%. And then what about right below or above? So remember we talked about intermarket sweep. So intermarket sweep could go right above or below the bid. So 1%, 1%. So that's the distribution relative to just the state of the bid and ask at the time of the trade. Okay. So let's keep going, building our picture. Then we might want to say, just tell me the top, 5 biggest trades, individual trades, not the total volume in the option. We're going to do that separately, but just top, trades in there. So we see here, June 18 put. We see 1,896 traded for $2.25. We interpret that as an incoming buy order. July 45 call, 1,188 for $14.20. We interpret it as a sold order, and so on. So these are the top 5 that we logged of big trades, and this kind of gives us an idea, where the big trades was there any particular pattern here, which I don't see. Looks like the top 2 were different expirations. One was a put, one was a call, one was a buy, one was a sell. So no particular pattern from the top 5 trades. We're not seeing top 5 trades, downside puts, or top 5 trades all in one expiration that's targeted at the money, all the buy. So this is just a quick kind of idea if there's a particular bias in those top big trades, right? Maybe just these maybe here look a little bit like in May. Let me see, May 30 call, May 30 call, May 30 call. So it looks like there's a repeat there. Okay. Maybe that's the only one that kind of sticks out. So three large May 30 call trades. So next, how is that volume distributed based on the moneyness of those options? So here is the call and the put. You could see that 37% of the option volume were in puts, right? This is the puts in the blue, yellow is the calls. So the top bar, 37%, the biggest one, were in puts that we consider tails. So tails are the ones that are the most out of the money. Okay, downside puts. Something, around 5 delta and below. So those would be tails. That's where that was the biggest volume yesterday. So not necessarily, and tails, think of it, they're not going to necessarily show up in the notional value because tails usually are the cheaper options. Okay, but about 37% of those were puts. I don't see any tails in the calls. In the money, 20% of the volume was in the money calls. At the money, 26% calls, 8% puts, and then wings, 9% of them were puts, no calls. And the wings would be options that are out of the money, but not way out of the money, between like the 25 delta to 5 delta. Okay, so these are wings. They're not near at the money, but they're not way out of the money either. They'll have a delta to them that they'll move around somewhat with the stock price. Okay. Next, how is the volume distributed based on trader size? Like, what are the participants? Is it just big traders in there? Is it a lot of small traders in there? How's that distributed? Who's participating in this? Well, this is the breakdown here. The smaller trades represented 33% of the volume. Retail size trades, 26% of the volume. So you could see here that that's over 50%, almost 60% of the volume were small and retail traders. A huge, proportion of the volume is coming from them. Then we have the proficient trader, 20%. So these would be already trade sizes that would be consistent of people, that trade a little bit bigger, not necessarily like large institutions, but already in a little bit bigger that wouldn't see in the typical retail trader. And then you got really big, large institutions or large traders, 21%. All right, so that's the distribution here. So it looks like it's tilted more towards small retail, make up a bigger portion of that volume. So how's that volume getting executed? Where is it flowing? We have a lot of different exchanges. Is there a particular exchange we're seeing it going to? Maybe there's more liquidity. How's that distributed? So here's the volume by exchange. ARCA 23%, CBOE 9%, Philly 9%. So the one that sticks out maybe is ARCA. Almost a quarter of the volume is going there. So maybe something to look at. Maybe there's price improvements there. Maybe there's more on the limit order book there. I don't know, but that one stands out a little bit. Okay. So then when we go down, we see this chart. Now this chart tells us how are the options getting impacted. Right now we're looking at the volume. We're getting a quicker picture, but how's the distribution of volume based on the expirations, and how is the prices getting impacted? So this is showing us the volume. Most of it is May 17th, so it looks like it's very the near term options are being used the most. Got some in May 24th. We see here this is the term structure and implied volatility sloping down, meaning that the markets are telling us the implied volatility in its current state is higher and expected to decline. The implied decline, the volatility is expected to go down as we go out further in time. So we're in a heightened state of volatility. Okay. And actually, where we market, we cap it at 400. It's right up at our cap at 400. So we don't even see this line shifting here. But this is how the term structure looks going all the way out, from present to going out to Jan 26. And there's not much trading on a relative basis as you go up further in time. Most of it is front loaded. And if we wanted to just see that table here, well, I'm up at 9:30, Will. So I'm going to stop.
And this is something we can talk about for going forward. Yeah. It's such a new and excellent feature.
Yeah.
Rob just notified us the bell just went off. Great job, D, as always.
All right. Thanks, everyone, for joining. Stay safe out there. Have a great trading day and hope to see you guys tomorrow.
All right. We did just get a question just popped up about the volume burst screener being available. I just got an error with the table when I typed in the address. John, just email support at Market Chameleon.
Yeah.
A screenshot would be very helpful. And that's the best way to go. If anyone has problems, email support at MarketChameleon.com. I'll put that in the chat. Awesome job, D.
All right. Thanks, everyone, for joining. Stay safe out there and have a great trading day.
Great. Trade in peace, chameleons. Thanks for all the questions.